Hi there, this is Max Keiser. This is the Keiser Report. Summer Solutions. That's right, Summer Solutions. Now, today we're covering whether or not gold price moves are signaling an end to the U.S. dollar with our guest superstar, Alaister Macleod of goldmoney.com. Alaister, welcome.
Thank you for asking me, Max.
All right. Well, Alaister, first of all, I might want to say, of course, Max and I are investors in goldmoney.com because we love the company and you do a lot of great research. So we're having you on here to discuss some of your research and the solutions to the issues. Now, when you look at gold and you look at the fact that it's soared through $2,000, do you agree with what Goldman Sachs, who is one of the biggest beneficiaries of the Cantillon effect of the sort of fiat money system, they say that the US dollar's days are nearing an end, and how they determine that in their report is that the gold price. So do you see those two as being related, and are they a little bit too doom and gloom that the US dollar is ending soon?
The answer to that is yes, they are related. I would put it slightly differently from the way Goldman Sachs describes it. There was a day earlier in this year when everything changed. It was rather like, the tide stopped going out and started coming in, or from the other point of view, stopped coming in and started going out. And that was the 23rd of March. Between more or less the beginning of the year and the 23rd of March, markets sank. The S&P lost a third of its value. You had gold was just absolutely knocked down. I mean, certainly the open interest was knocked down, though the price was a lot more resilient than you would have thought. And so there were various things that really were hit. I mean, even Bitcoin sort of was pretty weak in those at that early time. But then on the 23rd of March, something happened, and that was that the Fed made a statement which basically said, we will throw however much money it takes at resolving our economic problems. And at that moment, the market switched from being worried about deflation to suddenly thinking the outlook is inflation. The S&P took off, and we are where we are now. Gold and silver took off. The gold-silver ratio collapsed from 120 down to current 70 odd. Bitcoin took off. Oil took off, though there was that moment, and I think we discussed this in an earlier podcast with you, or video with you, that when gold dipped in April because of delivery problems on COMEX. But apart from that, oil also basically took off. So did copper, Dr. Copper, which tells us that the outlook was considerably improved after the Fed turned around and said, we will print whatever it takes. And it was also the day when the dollar's trade weighted topped. And it hasn't really stopped falling since then. So 23rd of March, I think, is a date we should all put in our diaries. That was when the world changed. And it is so remarkable that any idea that, for example, gold has had a wonderful run. Today it is down nearly $100. That's the end of the run. Forget it. It's not. Things have changed. So I agree with Goldman Sachs, but I would be a bit more specific about actually what has happened.
Right. Well, that was caught on by the financial press, the mainstream financial press. The Economist magazine had a front page cover story called Free Money. Basically, the sub headline, When Government Spending Knows No Limits. Right. So now the cat's out of the bag, that the governments are going to keep printing money ad infinitum to support these markets. And as you point out, the switch happened as being, well, we're in a deflationary world to possibly being in an inflationary world. But that seems to be, hasn't really been completely caught on by the bond market yet, right? Because the bond market's still reflecting this deflation trade. And when is it really the wheels are generally going to come off, Alaister?
Well, the bond market is reflecting weight of money, which is just being shoveled into financial assets, and particularly US Treasuries, by the Fed through quantitative easing. So that's why bond yields haven't recovered. It is so important for the Fed to keep these bond yields low, because if they fail to do that, the funding crisis that the US government will find itself in will be completely intractable. So it is absolutely key for the Fed to keep interest rates, funding rates down, to keep financial assets bubbling. If they fail to do that because they've committed the dollar to doing that, like they will print whatever it takes to keep financial markets running, then if they fail, the dollar will fail as well. And again, we've discussed this because this is a dead ringer for what John Law did exactly 300 years ago.
So let me pick up on that date of March 23rd, because I've also kind of mentioned this on Keiser report where I said something happened. I didn't specify that date of March 23rd, but that the mindset, the psychology of the global investor class, all participants in the economy, in fact, changed just like that day in August of 1971 when basically the US went bankrupt, right? They failed to pay back England the gold they were due and instead paid them in dollars, and we shut the gold window. So, at that moment, Nixon, nobody really knew if this thing was going to survive, the whole system, because this was a shocking moment in world history. It was the first time in thousands of years that we were on a global fiat standard. So I kind of feel like that the psychology snapped and changed, where all across the world, we all kind of adopted this MMT. And next stage of this all fiat system is like, I saw so many people saying, why do we need to pay taxes anymore if we could just print? The US government borrowed $3 trillion in the second quarter alone. I think in June, they borrowed as much as they had borrowed the entire existence of the United States. So, is this a psychological change, a shift in the whole mindset of the entire, all the participants in the economy?
Yes, it is. What you're describing, I think, is the reaction of government in particular to COVID-19. Government has actually no idea what's going on. It only understands when something is actually sort of hits it in the face, and that's what COVID-19 did. Before then, and lots of people in government will have forgotten entirely, we had the seizure in the repo market in September last year when it ran up to 10%. The other thing, of course, is that we had trade wars between America and China. Now, that really did do for cross-border trade. And if you remember, things like indicators like shipping rates and so on and so forth just completely collapsed. So we already had the makings of a downturn in the economy, which actually matched very closely in terms of its character what happened in 1929. Check this. 1929 was the end of a long period of credit expansion, bank credit expansion. 1929, October, was when Congress passed the Smoot-Hawley Tariff Act. That was the month when, from the previous September high, the market fell 35%, literally, by, I think it was the 11th of November, it bottomed out. Now, that's actually very similar to what happened to the S&P between roughly end January and March. Lost a third. And now we've got the rally. The rally is taking us higher than the subsequent rally in 1929 to 1930 took the Dow. But you can see the characteristics, the underlying background, what's happened to the market is just so similar. And then we think, okay, what happened after the rally? After the rally, and that was more or less when President Hoover signed the Smoot-Hawley Tariff Act into law, the market then went down and down and down. And by round about June, July 1932, the Dow Jones Index had lost 89% of the value from its high. So we've got, in terms of what's going on in markets, actually quite a similar situation. What COVID has done is it made forget that bit, and it's brought forward a lot of the disaster that we would otherwise face perhaps in due course. It's sort of made it here and now, and this is very serious. And of course, that's the bit the governments can now see. They don't understand, actually, there's a far more deep and worse condition behind it because of that parallel I've just made between now and 1929. So we are in really extraordinary times. Now, the next thing that happened after the 1929 crash, and then we started sinking from 1930 to 1932, was banks started going out of business. Now, at the moment, I'm writing an article on the GSIBs, the globally systemically important banks, and some of them are in deep, deep trouble. And we can see this from the point of view of the relationship between their balance sheet assets and their market capitalization. In the case of one bank, which I won't name on this channel, but it's a major European bank, the current ratio is 118.8 times. Now, just think about that. This is really extraordinary. €1 write-off on the balance sheet creates 118 euros worth of pain to each shareholder. This is gearing we have never seen before. And that bank isn't the only one. There are a number of other banks in the Eurozone. And the other thing that's happened, of course, is that the attack on Hong Kong, and it's a financial and verbal attack really from America, to which China has not acted sensibly, that we must admit. But what it's done is it's undermined the share prices of banks like Hong Kong Shanghai Bank and Standard Chartered Bank, which are British banks. And then if you go and look at the Chinese banks, what do we find there? The big four Chinese GSIBs, their share prices have all plummeted after an initial rally from that March 23rd date, which peaked on, I think it was the 7th of July. And since then, it has just collapsed. So we have banking and systemic problems in the making, and nobody, so far as I can see, is paying any attention to it.
This is exciting story, but we pick up after the break, Alaister. You know, you got me on the edge of my seat. Don't go away. We'll be right back with Alaister Macleod with the Keiser Report. Don't go away. Welcome back to Keiser Report Summer Solutions with Alaister Macleod and Max and Stacy. Alaister, let's get back into this story. You know, let me ask you this. So you make the comparison to the crash of 29 and then the early 1930s and then the rally and then the Smoot-Hawley was passed and then we went back into a huge fall, 85% top to bottom contraction in the Dow Jones. And you make a comparison to what's happening now. Now, of course, during that depression of the 1930s, that was a deflationary depression, which is different than an inflationary depression, which we saw during Weimar Republic back in the 20s. So what are we heading into here? Is it going to be a deflationary depression? Because if you say banks are failing, that sounds like deflationary depression. But you know, what about the other side of the coin here, where the money printing is attempted on this gargantuan scale and we go more like a Weimar Republic type deal? Alaister.
Okay, what we've got to do is to separate out this problem into two components. The first one is the problem the banks have. Obviously, if I know that these banks have far too much gearing, the directors of these banks are also fully aware of this gearing. And this is why, if you look at the growth of bank lending, it's actually started to tail off, and if anything, is beginning to contract. The problem they have is that they can't really contract bank lending without creating wide-scale bankruptcies. But equally, they can't go on just increasing bank lending. So that's one problem. That's the deflationary aspect that you were talking about. The inflationary aspect is really when you come to the Fed. The Fed is desperately trying to get money into the underlying economy to rescue production chains, companies which employ lots of people, to stop them going bankrupt, and so on and so forth. The problem they have is that the banks won't transmit the money. So the only way they can do it is to do it via helicoptering money through the US Treasury, for example, and following that route. So we have got two elements in this. We've got the deflationary element and we have got the inflationary element. Now, the way it will be resolved, in my opinion, is that we will have a systemic crisis. And the systemic crisis means that the Fed and the US Treasury, in your case, will end up basically taking control of the whole banking system. We'll be doing the same in our country. The Eurozone will be doing the same then. Japan will be doing the same. China will be doing the same, even though they're already there, really. So what that then means is that the politicians and the planners can instruct the banks basically to transmit money into the economy. into distressed borrowers, into sort of raising consumer loan limits, things like that. Whatever it takes, remember, that was what was said on the 23rd of March. So they will prevail. But in order for that to happen, the banks will fail first. The bit whereby banks are cautious because they are over-leveraged and they are frightened of going bankrupt, that has got to happen. That has got to get out of the way. And then the Fed can do its best to try and get money into the underlying economy. But that's not the only problem they have. Because if we have a banking crisis, a systemic crisis such as I've just described, and believe you me, it's very hard to see how it will not happen, then we have to ask ourselves, what happens to financial assets? Those lovely bonds which yield zero or less than zero in the Eurozone, US treasuries which yield, and I see the yield has just been rising, 0.6 something % for the 10 years. What's going to happen to all those? Well, foreigners are going to be looking at their dollar holdings and they're going to be saying, we got a bit too much of this. We got problems back at home. We need to reduce our dollars, keep a bit of dollar liquidity, but we can liquidate our portfolios. We don't want to have anyone else's bonds. It makes no sense at all. So we're going to repatriate our money. Then you will see that the dollar falls further and it begins to impact on this problem the Fed has, and that is how to keep financial assets maintained at high levels so they can finance US Treasury debt. And the answer is that at some stage, that game is going to fail. And when that game fails, then the purchasing power of the dollar will go down with it. So this situation, which started on the 23rd of March, will, I think, evolve into a banking crisis, and then it'll evolve into a currency and market crisis. And we've got that ahead of us, and it will not necessarily take very long for the whole process to complete.
But whatever it takes, of course, is also war. And we've had many wars from America in the past few decades, whether it's Iraq, Afghanistan, Libya, Somalia, Yemen. But those are tiny countries. The whole country will galvanize if we take on a nation like China of 1.4 billion people with a massive military. So everybody's noting this trade war. We're seeing smash and grab, right? The United States is just smashing and grabbing things like TikTok. ByteDance is the company that owns it because they're better. They've produced a better product than what the American companies have been able to. Huawei, same thing. So are we going to see possibly a hot war? And wouldn't that, of course, enable the Fed and Treasury and everybody to do whatever they want? Because obviously in a time of war, everything is on the table.
That's a difficult one to answer. I think there is no doubt that when you get financial instability, and when that financial stability particularly leads to people starving, literally, which could be the result of this COVID crisis. On that basis, yes, you get political disruption, and very bad political disruption. And one of the ways in which you avoid it being a civil disruption is you attack foreigners. And whether that's going to happen or not, I don't think at this stage we can really say. But there is no doubt that the American, if you like, Langley, the deep state, is still pursuing those sort of tactics. And I just wonder whether, how long will it be before they start to say, right, we've got to take Erdogan out because he is no longer a reliable partner. If Erdogan refuses IMF money, then I think his days will be numbered as far as the US deep state is concerned. So we've still got that sort of behavior. What my hope would be is that this crisis, ghastly though it will be, actually puts a lid on that sort of behavior. There will be other priorities. And effectively, what we're talking about is the state going bankrupt. When its money no longer buys anything, the state is bankrupt. Now, we can hope that, and it is no more than a hope, I would admit, that some wise heads would arise from somewhere and take control of the situation, and with the public's blessing, because at that stage the public will be very, very much aware of the mistakes of previous administrations, actually plot a course out of it. I mean, this is what Germany did with Ludwig Erhard after the Second World War. I mean, as the economy minister, he just took control over the whole thing. And he told his military superiors, the British and the Americans, I've done away with rationing. What? You've done away with rationing? That was in 1948. In this country, we still had rationing in 1954. So you need someone with imagination to deal with this. And at the moment, it's difficult to see where those people are. We've just got to hope they will arise. But I think your point, Stacey, about the political instability that is likely to follow is a very, very serious consideration.
So, Alaister, I want to kind of go back to something you said earlier about the Treasury going directly to the people, bypassing the banks. So another way, and I've heard this from different quarters, and another way to describe that would be they're going to nationalize the banks. And so that does play in also to your idea where governments start to become more autocratic in terms of how to deal with these problems. You described Germany in after World War II, et cetera, and that these measures, autocratic measures, were taken. So are we politically, does it look like countries, including the U.S., if the U.S. nationalizes their banking system and it's run out of the White House, that becomes very autocratic? Is that true, Alaister?
It certainly is autocratic. But if we've got, as I believe we have the makings of, a complete systemic disaster amongst big and small banks, and you've only got to look at the numbers to see this is a very serious risk, and not only is it a risk, it seems very unlikely we'll get out of it unscathed, then you can see that nationalization of banks is going to be happening everywhere. There have been stories that what the central banks really want is to take control of lending away from the commercial banks. And certainly the way the ECB has behaved about the commercial banks in its network, and remember, it's actually one step removed because the relationship is always between a national commercial bank and a national central bank. The ECB is like some sort of godlike figure in the background, sort of running everything. But the ECB would like, I think, to have more direct control over economic events, because these people believe that if you just inject money into an economy, you will rescue it, even though classical economics tells you that that is a load of hooey. But that is what they think. And I think, in a sense, when it happens, the central bankers will shrug their shoulders and say, well, c'est la vie. But at least we've got better control over events now. And I think that's going to be the way they look at it.
Okay, these are summer solutions. So for the ordinary person out there watching this, how do they protect themselves? What should they expect in the future? Is there going to be another post-Bretton Woods sort of post-agreement, a global currency grid? What's going to happen, and what should they do?
I don't see a sort of another Bretton Woods. What I do see is a crisis that's evolving so rapidly that there won't really be a consensus as to how to deal with it. Other than, for goodness sake, we must not let any banks fail. I think that would be the one point of consensus in the whole thing. As for protecting yourself over summer, the only thing I can suggest is get out of fiat. And there are two ways in which you can do that, one of which is not controversial in my view, and that is to have some gold and silver. And the second is probably a bit more controversial, but I think you understand, and that is have a look at Bitcoin or similar restricted means of owning money. I mean, restricted in the sense that they can't just be printed willy-nilly. So you've really got to get out of fiat. And depending who you are, if you are, let's say, a millennial who understands technology, your choice may well be to go for Bitcoin. If you're a bit old and fuddy-duddy like me, you'll say, well, gold and silver, that's going to come back as money. So I would say that's what all your viewers should really look at.
Right. Let's talk about Elvira Nabiulina over there at the Central Bank of Russia, buying 520 tons of gold just over the last 3 years. Awfully good timing on that. Well, history see her as a Charles de Gaulle figure. Remember, Charles de Gaulle got France's gold out before Nixon closed the gold window. Britain, of course, was left holding the fiat bag. Your thoughts, Alaister?
I think that's a very interesting comment. And the head of the Russian central bank is a very interesting person. When she was first appointed, I don't think anyone really thought this is a serious appointee. It's just Putin's economic advisor being promoted. But actually, she's dealt with a banking crisis. There was a huge, great banking crisis after she came in. She reformed the banking system, and that was really quite an achievement. I think the policy on gold, insofar as she has anything to do with it, almost makes her a sort of proto-Austrian in the sense that she understands the fragility of someone else's paper currency. And that is an important point for the Russians.
Yeah, fair enough. All right, Alaister Macleod, thanks for being on the Keiser Report.
That's my pleasure.
All righty, and that's going to do it for this edition of Keiser Report Summer Solutions with Max and Stacy. Once again, I want to thank our guest, Alaister Macleod from goldmoney.com. If you want to reach us on Twitter, it's Keiser Report. Until next time, bye, y'all.